You've seen the headlines, right? Some company announces record-breaking revenue, the stock price pops, and then a few months later, you hear that investors are actually losing money. Well, today, we're going to pull back the curtain on those financial reports. We're going to learn how to see a company's true health and look right past those shiny headline numbers.
This is the exact situation that trips up so many people. It feels like it makes no sense. I mean, if a company is earning more money than it ever has before, shouldn't its investors be popping champagne? Well, as we're about to find out what a company earns and what it actually gets to keep, yeah, those are two totally different stories. So here's our game plan. First, we'll nail down the huge difference between revenue and real profit. Then we'll walk through something I call the profitability waterfall. After that, we'll learn to look beyond the headlines, hunt for some financial red flags, or cockroaches, and finally, we'll wrap it all up into a simple toolkit you can start using right away. All right, first things first. Let's get this one idea locked in, because it is the key to everything else. Revenue is not the same as real profit. It's just not. Think of it like this. Revenue is the total amount of cash that comes in the door from sales. It's that big, flashy number they shout about in press releases. It's the top line. But profit is what's left after you've paid for every single thing it took to make that revenue happen. And I mean everything. That's the bottom line. To really get this, let's forget about giant corporations for a minute. Let's just imagine we're running a small milk tea shop. Honestly, this simple example is the perfect way to see how a real income statement works, from top to bottom. Okay, let's follow the money. We sell 1 cup of milk tea for 10 yuan. Boom, that's our revenue. But of course, it wasn't free to make. We had to pay for the milk, the tea, the cup. Let's say all that costs 4 yuan. What's left over, 6 yuan, is our gross profit. But we're not done. We still have to pay rent, our employee's salary, the electricity bill. Those are our operating costs. Let's say that's another 3 yuan. Now we're down to 3 yuan of operating profit. And finally, if we took out a loan to open the shop, we have to pay interest, and we definitely have to pay taxes. After we pay another 1 yuan for all that, we are left with a final net profit of 2 yuan. That is the actual money that ends up in our pocket. Now here's where it gets cool. We can turn these numbers into some really powerful insights, starting with the gross profit margin. In our little shop, that's 6 yuan of profit divided by 10 yuan of revenue, which gives us 60%. This number tells you exactly how profitable your product is, all by itself. A high gross margin, that usually means you have a really strong, competitive product. Maybe your tea recipe is just amazing. Okay, moving down the waterfall, the next stop is operating profit margin. So for us, that's 3 yuan divided by 10, or 30%. Now, this tells a totally different story. This isn't about how good the tea is anymore. This is about how well the business is run. How good is the management team at controlling costs like rent and salaries? This little number tells you how efficient they are. And at the very end of it all, we get to the net profit margin. For our tea shop, that's 2 yuan out of 10, so a 20% margin. What this means is for every 10 yuan that came in the door, only 2 yuan is actual take-home profit for the owners, or, the shareholders if it's a big company. This is it, the famous bottom line. So now we understand the 3 levels of profit. But here is where it gets a little bit dangerous. If you only look at that final net profit number, you can get seriously misled. The real story, the important stuff, is often hiding just beneath the surface. Just picture this. A company's main business is actually struggling. I mean, its operating profit is negative. But then, all of a sudden, it sells off an old factory for a massive one-time gain. Well, that's going to make its net profit for that quarter look incredible. If you only look at that bottom line, you'd think, wow, this company is killing it. But if you look one level up at the operating profit, you'd see the truth. Its core business is actually bleeding money. And this leads me to the single best analogy I've ever heard for financial reports. Think about buying a used car. The income statement with its big, flashy revenue number, that's like the car's shiny, freshly waxed paint job. The salesperson is telling you how great it is. But a smart car buyer doesn't fall for that. They say, show me the maintenance records. Well, in the world of finance, those maintenance records are the footnotes to the financial statement. The footnotes are where you find out all the juicy details, the real story. And that brings us to this classic Wall Street proverb. Because when you start digging around in those footnotes, you might start finding some things that are a little, unpleasant. It's time to go cockroach hunting.
Now, what we're looking for here isn't necessarily illegal. In fact, these are often perfectly legal accounting tricks that companies can use to paint a much rosier picture of how they're doing. Let's look at two of the most common cockroaches you'll find. Check this out. It's a classic. A factory buys a machine for $10 million. The company's policy says that machine will probably last for 5 years, so they record a $2 million expense each year for depreciation, which lowers their profit. But this year, business is slow and the CEO really wants to hit his bonus target. So what do? Buried deep in a footnote, the company just changes the estimated useful life of that machine from 5 years to 10 years. All of a sudden, the annual expense drops from $2 million to $1 million. And just like that, poof, without selling a single extra thing, the company's profit magically jumps by $1 million. That, my friends, is a cockroach. All right, the second cockroach we're hunting for is even more shady. It's something called a related party transaction. And let me tell you, whenever you see those words in the footnotes, your internal alarm bells should be going off like crazy.
So here's how it works. It's the end of the quarter and a company is just short of its big sales goal. So it sells a huge chunk of its extra inventory to some tiny, unknown company you've never heard of. On the main income statement, it looks like a massive sale. Revenue target met, everyone's happy. But then you dig into the footnotes and you find one tiny sentence revealing that this small company is actually owned by the CEO's brother-in-law. All they really did was move inventory from their warehouse to his warehouse. It wasn't a real sale at all. The truth was hiding there in plain sight if you knew where to look.
Okay, we have covered a lot of ground here, from milk tea to financial cockroaches. So now, let's pull all of this together into a simple, actionable toolkit that you can use every single time you look at a company's finances.
All right, let's put it all together. This is your new checklist. Number 1, if you want to judge the product itself, focus on the gross margin. Number 2, to judge how good the management is, look at the operating margin. 3, when you see that final net profit, always be skeptical and check for one-off gains. And finally, most important of all, if you want to find the real truth, you've got to read the footnotes and hunt for those cockroaches.
You see, the income statement is just one piece of a much bigger puzzle. But now you know how to read between the lines, and you've just unlocked one of the most powerful tools there is for really understanding a business. So the real question is, what other secrets are just waiting to be discovered in those reports?